Putting the spotlight now on the office market. India's Office Real Estate Investment Trusts, also known as, of course, REITs, their outperformance to the Realty Index has been quite telling. In fact, we're talking about 15% capital appreciation in 1 year. The key driver has been the underlying strength of India's office real estate market, triggered by heightened demand from GCCs. To talk about this and more, we have with us Somy Thomas, Executive Managing Director, Valuations and Co-Head at Capital Markets India at Cushman and Wakefield, and Vijay Agarwal, Managing Director at Equirus Capital. Somy and Vijay, thank you very much for being with us. You know, REITs are definitely coming center stage. And I know that because I'm looking at it from a personal finance angle, just the simple returns are becoming too interesting to ignore right now. But the question is that, is the cycle just starting? Can it continue to be so good? Because it's largely a play on the booming office market. So, Somy, why don't you lay out the ground for us first in terms of just how rentals are moving up? Is it pan-India or is it specific markets, say in Bengaluru, in Mumbai, which is where this office demand is coming in from?
Thanks, Surabhi. I think it's very important to note that most of the office markets across India is doing quite well. It is driven by the GCC demand, the global capability centers. There are headwinds on the IT sector, but we need to really look at the importance of the GCCs for India. So it is most of the GCC market, like you said, Bangalore, Pune, Hyderabad, Chennai, even Gurgaon for that matter, is doing quite well. So the underlying growth on rentals is more than a inflation-adjusted rental growth. So 7 to 8% rental growth we are seeing in most of the core markets of real estate, not necessarily across the outskirts as well, but the core markets. So the talent pool availability is a big factor for GCCs. So they're willing to pay more rental in the preferred micro markets to attract talent. And that's why the rental growth is doing well. And we can see that in the REIT performance, we have a 15% growth in the last 12 months across most of the REITs. And they're doing quite high in occupancy. We have close to 90% occupancy in all the three listed REIT office REITs. Of course, the retail REIT is doing phenomenally well. That's at 97% occupancy.
Somy, just to follow up on REIT returns, and correct me if I'm wrong, I looked at some data, but that was, I think, a month or two back. Average returns can have been ranging in the mid-teens. And, net of tax, they're looking very attractive at a time when the equity market is barely giving you, 10% in a year. Is that sustainable? I mean, what is a realistic expectation to have in terms of IRR when it comes to REITs?
Absolutely. You said it correct. In the today's market, it's a sustainable returns. We are seeing that quite attractive returns because of three factors. Like I said, GCCs, supply constraint is still there in the market. The core of the markets, like, for example, BKC in Bombay or Goregaon, Powai, these kind of markets, it's difficult to create new supply. So existing tenants are renewing at higher rentals. Like I mentioned, it's very important for these companies to be in the right area to attract the good talent. So we are seeing a mid-teen returns for most of the REITs. And I think with the GCC demand picking up in India, it is quite sustainable.
Gentlemen, morning. Good to have both of you here. Somy, Prashant here. Somy, now, when you look at valuations, right? When should one buy these products? I'm assuming when interest rates are high, right? At the top of the cycle in that sense, right? Yields are high. So you get, there are better pickings. Is that the state we are in right now?
Interest rates obviously are an important factor to give returns, but it's also important to look at the underlying demand factors. We came off at COVID, which created headwinds around the return to office scenario. And even today, maybe some of the developed markets, even in Asia like Japan or Singapore, you probably don't have very good performance in the REIT market. But markets like India, where return to office has become a reality and people want them to come to office for all kinds of reasons, including the new headcount they're adding every year. And they have not met their managers, or they're not really bonded with their colleagues. And innovation and ideas will only happen when you come to office. So we are seeing quite a strong trend of return to offices and a huge demand from the GCC space. So interest rate is one function. Of course, we are already seeing the benefit of interest rates already reduced by 50 basis points recently.
Somy is, and maybe both, Vijay can also come in on this if he wants to. It's an asset class which is just about taking off in India, right? I mean, there are 4 listed REITs, three are in the commercial space, 1 in the retail space. There is 1 more which is coming. I think Sattva is coming to the market. So it'll be 5, but total market value is $12.5 billion. In the US, for example, it's trillions of dollars. But AI, it's a slightly off-tangent question. If it increases productivity, reduces the need for as many employees, as many seats in the office, fundamentally, where does that leave? Where does it leave things? If either of you wants to take that question briefly.
I think I can take it. I think we have to look at the AI, how AI will impact the demand for office space. I think it can have an impact on the very lower level coding level, not broadly across the. We will not see that the AI will replace human being completely.
No. My point, Vijay, is of course it will not. But it's like a pyramid, right? Any organization.
Yeah.
I mean, as you go higher, there are lesser people. The vast majority is the lower end. But if the lower end, as you say, is essentially going to get disrupted, then you don't need as much office space.
Yeah. So we had seen these things when the banks were getting digitized. That time also we had a lot of concern about the manpower, what will happen to the manpower. And if we see our data for 30 years, the banks have increased their manpower strength. So looking at, I think Somy can also chip in here. We don't see.
I'll probably take it. I'll probably take that question in a different manner. Just look at the absorption that NVIDIA is doing in India, or there are certain multiple examples of chip companies and AI-driven companies creating India as the most important base, right? So we have seen some of the other large cloud players also increasing their presence in India. So what is really happening, Prashant, from an Indian context is that India is the cornerstone of a strategy for AI for most of these companies. Yeah. The kind of work that is happening has moved completely beyond the call center, the BPO, the law and coding that Vijay just mentioned. We are talking about doing very high-end R&D work in India.
So that point is very well taken, that there is demand. GCCs are booming. And, that's showing up in office demand as well. I have a very simple question to you, gentlemen, from an investor perspective. Now, you can either invest in REITs or you can simply buy the underlying stocks. And a lot of these companies have mixed developments. I mean, they've got office developments as well. What could be potentially a better bet, say, over a 3-year period? Vijay, what would you do? Yeah. Buy the underlying real estate stocks or invest in REITs?
I will take it differently. How is your risk appetite, basically? See, if you see REITs are a very stable income product and it replaces your bond yields. And see, suppose if you are looking to invest in a stable return product like a bond, then I would suggest you invest in the REITs because REITs give you a much better return than bond. With the same security, because underlying you have a real estate and real estate value will never go down in India, definitely. So that's the underlying assumption. And you, instead of 7-8% and now 6% with the rate cards, here you are getting a 12-13% overall return. So I'll suggest to do that, invest in the REITs. But if you have a risk appetite, probably you can go for a stock investments in the select real estate development companies which have a mixed portfolio. You can have a Phoenix also, and you can have a Oberoi Realty, and Lodha is increasing. So you can play the game. But suppose if you want to buy and forget, then REITs will be the better option. If you see a Nexus REIT, it has given more than 25% return, yearly returns. So that's a fantastic return. You can't get in the stock. And the best part for REITs is that it doesn't go down like a stock market.
That's the thing. And investors are very savvy. They're hearing you say 35% return. They're very quick to, tweak their portfolios where they think there's perhaps other value. And I think REITs are going to become quite a defining product that people will at least look at in the years to come. Thank you very much, gentlemen, for joining in on what is an interesting conversation, a very, very interesting asset class. 35% return in last 1 year, Nigel.
Well, Somy and Vijay have given me some food for thought. We'll do some, analysis on this over the weekend. Thanks a lot, gentlemen, for joining in. Look forward to catching up with you all rather soon.